The Morgan Report with David Morgan.
David Morgan with you with the weekly perspective for the week ending 11 January 2019. Well, the markets are acting in what I would call typical manner, which means higher risk, a move to safety, and safety in the establishment means the bond market. Ratio analysis shows that investors are in a major shift out of stocks and into bonds. In fact, all bond categories have outperformed stocks since October. So that shows you that the traditional flight to safety is well and good. Longer-term treasuries are doing better than investment-grade corporates, which is obviously another tip to the bond market, meaning that the government-grade bonds are higher rated and more trusted than corporates, and that's, again, typical. While the high-yield junk bonds are the weakest in the bond category, obviously true if you go back to the Great Depression. A good place to be was in corporates if and only if you pick corporations that weathered the entire Great Depression, which were few and far between. A lot of companies, as we all know, went out of business. So this is showing caution by investors at large overall, the whole scope of investors, not just resource or gold investors, but investors at large. And at this part of the cycle, I actually quite pleased to see this. The run to gold will not take place this year. You'll start to see in my studied view a shift into the metals more and more as the year progresses, and it'll have its ups and downs. And I'm looking for a good year, not a spectacular year, although the market might surprise us. Regardless, that shift is taking place and will continue. In the meantime, everything is set up as I expected to see it in this, let's say, last leg up for the gold market. Continuing on, this is from Our Finite World, and the subtitle here, which is in small print, Electricity Won't Save Us from Our Oil Problems. 2019, world economy is reaching growth limits. Expect low oil prices, financial turbulence. A very good article. I'm not going to read the whole thing, but I really do want to go through this a little bit more thoroughly than I do most weeks. First thing pointed out, of course, is the author says, that the world economy is gradually changing from a growth mode into one of shrinkage. And they go on to talk about shrinkage in three main areas. And those three main areas are complexity, debt bubble, and the use of resources. And all three are taking place at the same time. So I'm going to digress for a moment, but The Collapse of Complex Society is a very good book. I've read it. And one of the ideas in the book is that the higher the complexity of a society, the more easily they can go into degradation, or I'll call it collapse. Debt, I talk about it every week. I don't think I have to add on to that. And use of resources, basically misallocation of capital. I mean, is it more efficient to use the available energy, as an example, for public transportation than it is for everybody to drive their own automobile? Well, it's pretty obvious what the better use of resources would be. It might not make everybody happy. People like driving their own cars, yada, yada, but that's not the point. The point is, if we had to do all over again, or restart or reboot, what would be a better use of the availability of the energy and everything else that we have? And of course, the answer to that is probably a different scenario than the one we're witnessing as I speak. Another interesting part of this article is talking about the tariffs, and they call Trump's tariffs. But as they point out, if a person looks at history, it becomes clear that tariffs are a standard response to a problem of shrinking food or industrial output per capita. Tariffs were put in place in the 1920s, in the time leading up to the Great Depression, and were investigated after the Panic of 1857, which seems to have indirectly led to the Civil War. Whenever an economy produces less industrial food output per capita, there is an allocation problem. Who gets cut off from buying output similar to the amount that they had previously purchased? Again, this goes with, I won't say my theme, but the theme that I've outlined for 2019, which is stagflation. So a stagnant economy, a non-growing economy, particularly in the foodstuffs, is my study. And also increasing prices, which goes hand in hand. If you've got less of something, it's probably going to cost more, especially if it is a need and not a want. So be aware of that. Another key here, which you've heard time and time again, but probably the most important thing I can say, growing debt bubble will help keep commodity prices up because of a rising amount of debt can indirectly provide more demand for goods and services. For example, if there's a growing debt, it can be used to buy homes, cars, vacation travel, which require oil and other energy consumption. However, if the debt level becomes too high or the regulators decide to raise short-term interest rates as a method of slowing the economy, the debt bubble is in danger of collapsing. A collapsing debt bubble leads to recession and falling commodity prices. So my scenario this year is I think that the money metals will do well, and I'm not sure that all of the commodity sector is going to get a lift this year. I do think that the ags will, the agricultural, the foodstuffs will. But again, this remains to be determined, and time will tell. And of course, as the population grows, there's a more use of resources. I won't read that paragraph. I think this one's more key. The other problem with the growing use of resources is diminishing returns, leading to the rising cost of extracting commodities over time. This goes right to the heart of the oil situation, which is energy return on energy invested. And this is still a problem. Yes, I know the oil situation, lower oil, the article talks about. Certainly oil's come off a great deal. The point being that electricity isn't going to save us, at least at this point in time. But we are a energy dependent society, and I mean globally. And so very, very interesting things ahead of us. This paragraph goes on to talk about even water has this difficulty, and I'll digress. I watched The Big Short for probably the fourth time recently, and as anyone that's watched that movie even once will realize that at the end of the movie it talks about Dr. Burry, and he kind of goes through the heartache and headaches that he went through being correct, but all the suffering that he had to endure as the markets, even though he was early, had to really a lot of hate and vitriol thrown at him, even though most of the people that stuck with him that he pretty much locked in made money. I'm sure a few of those apologized. Anyway, the point I'm getting to is that he's looking at one commodity only, according to the film, and that is water. And water, of course, goes along with food. Those are two commodities certainly that you should be looking at in my strong view. Why inadequate energy supplies lead to low oil prices rather than high. In the last section, I discussed the cost of producing commodities of many kinds rising because of diminishing returns. Strangely enough, higher costs translate to higher prices only sometimes. When energy consumption per capita is rising rapidly, rising costs do seem to translate to rising prices. Spiking oil prices were experienced several times, blah, 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 blah. The prices of goods and services made with these commodities become unaffordable for lower wage workers, indirectly decreasing the growth rate in energy products consumed. And you can go and study this further. I think I'll wrap it up by their conclusion here. What is ahead if we are reaching economic growth limits? Of course, are we or aren't we? Well, I think we are, but they're asking the question. Figure 1 at the top of this post seems to give an indication that ahead of us after 2019, but this forecast cannot be relied upon. A major issue is the limited model used at this time does not include the financial system or debt. Even if the model seems to provide a reasonably accurate estimate of when the debt limits will be hit, it won't necessarily give a correct view of what the impact limits will be on the rest of the economy after limits are hit. The authors, in fact, have said the model should not be expected to provide reliable information regarding the economy will behave after limits have started to reach an impact or on economic output. So, in other words, it's sort of a big caveat, CYA type of thing, because it will be a distortion that will vary where you are. I mean, I think the unraveling will be extremely difficult in some areas, mostly high population densities that are at the margin where, the food prices are already extreme or unaffordable by many. That would have a different type of repercussion than you would in the area that had ample food supplies and mostly people were either employed or covered by some type of social mechanism such as food stamps or the equivalent. So that I think is a good statement, but I just want to think through it a little bit deeper. Number 2, as indicated in the title of this post, considerable financial volatility can be expected for 2019. If the economy is trying to slow itself, stock prices will be erratic Interest rates erratic, currency relatives to others will bounce around. The likelihood that derivatives will cause problems for banks will rise because derivatives tend to assume more stability in values than now seems to be the case. Increasing problems with derivatives raises the risk of bank failure. Derivatives are a huge problem. And the third and wrap-up point here is the world economy doesn't necessarily fall all at once. Instead, prices that are, in some sense, less efficient uses of energy may shrink back. During the Great Recession of 2008 to 2009, the countries that seemed to be most affected were countries such as Greece, Spain, Italy, that depended on oil for a disproportionately large share of their total energy consumption. China and India, with energy mixes dominated by coal, were much less affected. So I'll leave it at that. I will pause here and move on to gold and silver, and we'll call it a week. Moving on to gold, this is straight from Bloomberg. China adds to gold reserves for the first time since October 2016. Highlights of the article: the world's biggest producer and consumer boosted holdings of bullion in a month marked by mounting concerns that China's trade dispute with the U.S. is threatening economic growth. Spot gold had its strongest month in almost 2 years as those fears speared gyrations in equities and the dollar and boosted demand for precious metals as a safe haven. I won't read the whole thing. Most of you are already aware of this, but it is quite interesting that China and Russia and India continue to build their gold reserves as the, let's say, world economy becomes more and more uncertain. And finally, wrap up, say a little bit about the silver market. I'm just going to show you my Twitter feed. If you're not on here, I mean, it's free, and I do post a lot. Almost all of it's for me. Usually I post things that have to do with the economy or the precious metals. Very little junk. Yes, there is some self-promotion. I mean, I have to make a living like everyone else. So I'm not going to read these all to you, but a little bit about, I'll be at the Anarchapulco conference. This is an article I'll be writing for the next editorial in the Morgan Report. I'm going to be talking about silver as money. The webinar is out, the 2019 Outlook webinar. Well, it should be, probably could do a better title. It's the markets outlook for 2019, what I think about gold, silver, the bonds, the US dollar, and equities. Pretty much that's what I cover. Also Bitcoin. I actually start off with Bitcoin. So if you're interested in those markets, I tried to keep the video, I think it's around 12 minutes or so. It's pretty short and sweet. It might be a bit longer, but I go through all those markets in fairly good detail and give you my outlook. But here's the one I want to focus on. This will be coming up. I'll be doing a debate with Lewis, and I won't mispronounce his last name, starts with a C, and he's from Small Gold, and I really appreciate his thinking. He certainly thinks outside the box, and he's not afraid to, hold people's feet to the fire. So I'm going to click that, and there it is. We'll be doing this debate on the 31st at 7 p.m. Eastern Standard Time, which will be 4 p.m. my time. And you can tune in here live. So if you're interested, I suggest you climb on board. It should be fun. Gentlemen, very respectful, both sides. I mean, look, this is going to be a discussion, call a debate, that's fine, on the merits of silver as a monetary metal. So again, if you're so inclined, I would ask if you could help us a little bit and send this out on your social media, your email, or whatever. I'm not sure we'll be able to tune into questions or not. I didn't set it up. This Philip Kennedy is the one that actually approached me and asked me if I'd be interested. I told him I am, and I would be. And here's his, his Twitter site there. So I guess I'll leave it at that. I've gone about 12 minutes. I will keep you updated on the financial markets, gold and silver, and the economic situation we all find ourselves in. And remember, there's nothing more powerful than the truth. The truth will set you free. There's nothing really to be fearful about, although I may sound it at times. Humanity has been through it several times, and usually after the reset, we come back with a better set of values, meaning, more depth, and more humanity. So there is a positive side to this whole thing, and I think the crumbling has begun quite some time ago, 2008, and it continues as I do these updates. And may everyone have a great weekend. I'll be back with you next week.
Stay up to date on everything in the global economy, the currency crisis, cryptocurrencies, and the hard asset sectors such as gold and silver. Sign up for our free weekly perspective updates at themorganreport.com. While you are there, be sure to check out our membership services, where you can get expert trading recommendations and read analysis for just $50 per month. The Morgan Report is a world-class publication aimed at helping you secure your financial independence, regardless of the economic outlook. It's the knowledge you need to protect and grow your wealth.